Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Caleb Silver, Editor-in-Chief at Investopedia, as well as Max Cabasso and Maddie Radner on the Nasdaq Market Intelligence Desk. We're here to discuss the AI trade, and if it has more substance than the dot-com era, we'll also get into the bifurcation of the economy as well. And Caleb, as a steward of the markets and having a lot of historical knowledge, this feels, and I know the expression no one likes it feels different. This time, our dependence on technology is very different than it was in the late 90s.
Absolutely, and it's not just a couple of companies that are into it. A lot of companies get the headlines because they're big, NVIDIA namely, but think about the other companies that are its biggest customers. These are the biggest companies in the world that are buying from NVIDIA, buying from other companies, producing either chips or producing products that contribute to that AI ecosystem, so it feels broader. And then if you think about these rallies we've been seeing in utilities, because we're going to need more capacity, because we're going to need more data storage, that just tells you it's bigger than just AI stocks and just a narrow slice of tech.
Yeah, well, I happen to agree with you, but Maddie, you'd pointed out in your notes here, you know, the stock has a greater market cap than an entire index.
Mm-hmm. Yeah, I mean, NVIDIA it's determining where the major indices are going to go for the day. I mean, yesterday it was down, but we saw the smaller caps finally see a rally. Today we're seeing a little bit of a reversal. I mean, large caps are determining where the major indices are moving. The Mag 7 is responsible for 60% of the S&P's returns year to date. The gap between the S&P index and the equal weight index is continuing to widen. So that AI trend is really just leading the market.
Right, but it's not even just the larger cap indexes. I mean, you also noted that small cap indexes as well, they're concentrated.
Yeah, right now people are referring to the Russell 2000 as the Russell 2. There are two mega cap companies in the index that will change on Friday when we see the reconstitution take place, but actually Super Micro has been a $50 billion company for pretty much the whole year. So it's been a unique year for the composition of the Russell 2000. It's supposed to be 2,000 small mid-cap companies, but it's kind of a unique year with two mega cap companies kind of leading the index.
And Max, to Caleb's point, I mean, it's because it has the exposure to derivative play of NVIDIA.
Yeah, of course. As Supermicro has gone gangbusters, and we've talked about a lot recently, the underperformance of the Russell 2000 versus the large and mega cap indices, and how much worse that would actually be if Supermicro and MicroStrategy weren't in the index carrying the returns for the Russell 2000. That would actually be even worse. And it's something we were talking about kind of earlier, that herd mentality now. It's everybody's kind of piling in to that one trade. You know, we've been looking, for a few weeks and months now about kind of what's that next level of the trade. We were talking about utilities, kind of who's going to benefit from it next. The first trade was obviously the chips, where they saw the biggest increase, but hopefully we start to see that start to broaden out. But again, as we're talking about that herd mentality, the high conviction trades, everybody seems to be piling in. I don't want to say it's where the easy money is. Maybe the easy money's already been made there, but you're kind of waiting to see, does that flow downstream and others get to start picking up? Because if it goes the way it's been going, everybody tries to leave at the same time. That's when that trapdoor gets pulled and things get nasty.
Well, Caleb, this isn't idiosyncratic to NVIDIA. I mean, we saw this in the late 2000s, early 2010s with Apple. If you had any exposure, whether on the supply chain, it was great for your stock.
Yeah, large caps move the market, as she said. Weight moves markets here, but you could go to Apple, you could talk about the internet stocks, you could talk about telecom in the 80s, the railroads at the turn of the century. This happens, right? This is not crazy to have a few stocks leading the market, and it's not that crazy to have this concentration where you have 1/3 really of the S&P 500 with positive returns and the other 2/3 with negative returns year to date. That actually has happened a lot since 2002. That's kind of the way the market is today. Winners win, and the others are either trying to play catch up or people are just not that interested. But when you have this type of frenzy around story stocks, NVIDIA is one of them, Supermicro is another one of them. It was GameStop and AMC back in the meme stock days. You get the herd mentality, and we saw this big sell-off in NVIDIA over the last few days. Guess what? As soon as that fell below a 10-15% correction, buyers came back in. They don't want to miss out.
Well, of course. I mean, if you're a portfolio manager and you have not had exposure to a stock like NVIDIA, you're below your bench.
Right.
You have to show performance.
And you got to explain that to your clients. Like, why weren't we in NVIDIA? Did you miss like a 16?
Like a headline?
Yeah. Did you miss a 165% rally because you just didn't want to buy it? You have to be in these stocks if you want to have positive returns, fund managers and individual investors.
Yeah, and Max, we've spoken about this too. If you think about it more holistically in terms of the economy, if you look at the composition of the S&P 500, right? Used to be energy and financials that had the heavy weighting. The economy has transitioned to a more services, technology-focused environment, and you're seeing that with the weighting that technology has.
Yeah, I mean, they're driving the boat right now. But you're, like we were talking about, is this the same as, kind of .com, or is this more real and substantive? There's actual revenues that you're recognizing here that companies are seeing, improved efficiencies. So it's not so much, I have a website, .com, give me this huge valuation. You're actually starting to see money being put to work here versus, again, prior to .com. So there's big talk about growth outperforming value. Again, but growth is tech. That's where everything is going now. So again, we'll see if that starts to turn a bit, but that's where the money is being made now. It's in the margins. They have pricing, capacity there. So that's where the money's being made. And end of the month now, especially end of the quarter, end of the first half, you're going to see those trades that are working. Portfolio managers that weren't involved put on a little piece of it and say, okay, look, we are here, we're involved, we're a bit. NVIDIA in particular, I think there was a bit of index arb after last Friday. Seeing some selling now, but again, like you said, it got bought up quickly. Someone saw a discount. All right, we got to get back in and kind of show that we're here, and that's where the money's going. It's tech, tech, tech. Until that trade stops working, you're going to continue to see money flowing in there.
Right. But Maddie, I think Max makes a great point here where investors are being more discernible in terms of where they're putting their money. I mean, you cover small caps, you cover biotech in particular. You see the flows.
Yeah.
You know they're going to companies that have solid balance sheets, have good governance, and they're either close to market or really, near the end of trials and so forth. Investors are being more discerning, and why shouldn't they be?
Yeah, I think in 2021, where we saw over 1,000 IPOs come to market, those have kind of been weeded out a little bit. So we're now looking at quality companies over quantity, especially when we look at some of those small cap biotech companies that are coming to market. We're expecting one later this week. So they are coming back up. That interest is there for IPOs as well as companies that are currently listed. So it might take some time for them to catch up to the broader market, but we're starting to see that appetite start to come back.
So the pipeline looks better.
Yes, yes. There
a lot of SPACs though.
Yeah, we saw 3 SPACs last Tuesday, which was surprising. That pipeline is opening back up, especially after, again, a couple years ago, the 600 plus SPAC IPOs that we saw, that backlog is improving. So again, we're looking at quality over quantity with SPAC IPOs and some of the sponsors
demand is there.
Yeah.
It is.
The demand is there.
That's what my question is. How do you interpret?
Kind of worked through it, right? So after we saw the craze in 21, where everybody came in, everybody got a blank check, then they had 24 months essentially to go out and operate, find somebody to acquire. There was a ton of capital out there looking. They didn't trade well. We've kind of gotten through that now. Anybody that was previously, it's worked through. The sponsors and the founders of the SPACs have kind of reworked it because of the demand, essentially laying out a little bit less capital in terms of what is at risk on their end. So there is a demand there. But again, I don't think it's going to be as huge as it was because there's more focus on quality. It's not just go out and find something and make it work because of how everything kind of traded after. Now we're interested, there is a demand for it, but it's got to be of a higher quality versus just, oh, there's SPAC or there's IPO, yeah, throw money into it.
How do you interpret it with the SPAC volume that we're seeing? It sounds like risk appetite-ish.
Oh yeah, promiscuity is back, but we are also at the end of that 24-month window for a lot of these SPACs that were formed. So they have to put the money to work, and the fact that we're kind of near or at all-time highs, that's as good a time as any to take a company public via a SPAC. There is enthusiasm in the market. We survey our readers every couple of months on how they're feeling, bullish, bearish, what are you worried about? What would you do with an extra 10 grand? And you know what they say for the first time in really a few months? Individual stocks. They want to be buying individual stocks. They're looking for action. Now these are mostly index buyers and ETF buyers, but they do have their favorites and they're the biggest stocks in the market. But if you gave them more money, if they had extra cash, they'd put it to work in individual stocks. That tells you that there's a promiscuity going on right now. People feeling a little bit frisky, and that's a little bit dangerous when kind of everybody's feeling that way. That's usually when things don't go well. We'll see what happens this time.
Caleb, let's take the conversation a little bit further in terms of the retail investor and the bifurcation that we're seeing in the economy, because you'll read some surveys where there's a segment that believe we're in a recession, that employment's the worst that it's been in 50 years, when the data certainly doesn't support that. However, you look at balances in investment accounts, should you have one, It's telling a very different story.
Yeah, it's a tale of two countries in a lot of ways, and it's the shareholders who have been benefiting from this rising asset prices and stocks and everything else, and homeowners who own their homes and have seen their home appreciation go up. So that's the wealth effect taking effect, but most people don't feel that. People feel the economy on a personal level. We call it personal finance for a reason. So the headline numbers will tell you one thing, but if you're out there working a job, trying to fill the fridge every week at the grocery store, filling your car with gas, paying a mounting insurance bill that just keeps going up seemingly every single month, then you don't feel like the economy's that great. Forget the headline numbers. People feel it on the day-to-day every time they open up their wallet or use their credit card or look at their statements.
Yeah, and Max, we talk about this all the time. We are reflecting on prices that were there in 2019, beginning of 2020. So even though there could potentially be disinflation in the data that we see now, when things are 20 to 25% more expensive, and even there have been wage increases, it hasn't been keeping up. And we're going to hear about that a lot. It's an election year. It's not going away, the conversation.
For sure. It's the difference between how economists look at data, the rate of change, versus how individual consumers look at the same data, the same numbers. They're looking at the total change, and it's 25% more expensive. You go get milk or eggs or cheese or go get gas, whatever it is, almost everything is more expensive. You see that on a day-to-day basis when you're going out, you're paying for your food, your gas, or insurance. That's what you see. Not that it's up, oh, it's only 2% now. Okay, inflation is under control. Wait a second, it's still 25% higher than what I'm used to paying just 2-3 years ago. So that's the difference between kind of how people feel versus what the data is saying. It's, again, the difference of the rate of change versus the total change, and that's where you're getting that, kind of bifurcation. And also the kind of, would you do it for another 10 grand? And the individual stocks, I tend to look at that as not as much, not gambling, but as, I think, potential quick money that I'm smarter and this is going to be the one that helps me, make outsized returns that, I'm not going to get if I'm just sitting in the S&P 500. Even if you're up 19% for the year, which is a great gain, you see these other individual stocks that are up 50, 60, 100, 200%. So that's the one. The one I'm going to buy is going to be that one. So it's that kind of hope behind it versus actual investing for the long term. It's that I think this is going to give me a 2-3x in a short term, and that's going to help me.
See, and that's a concern when we think about personal finance, Caleb, because even if we were to get 25, 50 basis point rate cut this year, that is going to perhaps impact savers because the rates might come down a bit. However, it's not going to move the needle for people who are severely in debt. Sure. So what if I take that $10,000 and I apply it towards that debt? Because chances are you're not going to get a return that's 25, 26%, right, with the exception of 1 or 2 stocks.
Yeah, that's one of the choices. Would you pay down debt with this? And now they've been saying now for a few months, no, we want to buy individual stocks. They want to take the bet. They want to find the one that goes up 1,000%, the next NVIDIA. So there's that. But also there's this feeling like, the inflation is something we can't control. It's just something we have to deal with right now. So people are dealing with their own way. When you look at the consumer confidence numbers, no surprise there, but the future expectations for the economy, that's at a 13-month low right now. And the economy is growing right now. Unemployment is still pretty low, but people don't feel like it's going to get better, and they're right because prices are not going down to 2019, 2020 levels. That's the past. This is a new level set for consumers, for households, for investors on where inflation is going to be and where rates are going to be. And you said it, rate cuts cut both ways, right? You cut rates, that's bad for savers and people that are earning 5-6% in a money market or in their high yield savings account. They're not going to feel so good about that when it really doesn't move the needle for people who are in a lot of debt.
Right, but see, that's the whole thing. I just feel like I'd be more scared if I had that much debt and it just compounds and I can't pay anything off, and versus losing 1% in my savings account. To me, like, that would keep me up at night.
Yeah, it's a debt doom spiral that people get into. Right. Like, I can never get out of this, so I might as well take a flyer on a bet and bet on some stocks or buy some crypto or something like that.
A little bit of FOMO with all the stocks that are rallying at such crazy paces that we've never seen before. Like, NVIDIA added $1 trillion to its market cap in 30 days. So I think there's that FOMO aspect coming into the marketplace, and people are willing to put bets on some of these larger cap companies.
Especially when you've been in a market, let's call it, for the past 10 to 12 years, with the exception of the volatility that we've seen from 2022 up until the beginning of this year. there's a generation of investors, and even for older investors such as you and I, where there's short-term memory, and you've only seen stocks go from the bottom left to the top right of the chart. Things have been working. People were home. They were making money in digital assets. They were making money in meme stocks. And if I did it once before, I can do it again. But the market is just very different now. People don't have that kind of liquidity. And by the way, Caleb, you know, there's different types of liquidity. Accessing credit is a form of liquidity that's different versus the savings that you might have had during COVID, and I guess that's the broader conversation. Anyway, that's.
Well, that's why we see a lot of people searching for best personal loans. Can I tap my 401k? How much money can I tap? Can I get out of my house if I need to borrow from my house? We see a lot of people looking to raise capital either to get out of debt or have enough money to pay those monthly bills, while at the same time you see a stock market at or near record highs, and you see relatively low unemployment.
But I also think the point is, just because you say that the system is flush or was flush with liquidity, and I'm at fault for doing that, but there's different types.
Absolutely.
The Fed has liquidity. Credit can be accessed as a form of liquidity, and you certainly don't want it to be skewed to the credit side, I would imagine.
Yeah, absolutely not. But again, if you're a shareholder or an asset owner, you're fine. You can borrow against those things. If you are not, then you're looking for ways to try to make it month after month after month.
All right, great conversation, guys. Appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.